Well, welcome everybody. It's a delight to address you again. It's always interesting to watch yourself present. It always shocks me how fast I speak, so I'll try and slow it down a little bit. Um, our friends at CDIAC requested that I walk through some additional material just to bring this home and make it as real as possible. So we put a couple of case studies together for you. The intent is to give you some situations. They're actual situations that have been observed here in the state of California in the last few months, in the last 6 months, and perhaps it might engender some discussion about what you might do. And my hope is that perhaps you may have questions about these, and you're welcome to ask them in the chat box. Uh, Perhaps you may want to visit the small group sessions later in the week, and I'm going to be there, and we can talk about these. So that's the intent here. Angela, why don't we go ahead and go to the next page, and let's take a look at the first one. Thank you so much. So this is a case study of an actual city that I've observed and worked with. Well-run, great team, but they're battling the coronavirus impact to their local economy. Um, they generate almost I would call it a little bit over a quarter, maybe almost a third of their revenue from transient occupancy tax. So they're heavily impacted by the tourism industry. And as you can imagine, restrictions statewide or even at the county level have heavily impacted that revenue source for them. That's been a negative to their balance sheet and their budget. They make another 24% from fees and charges, and that's stayed on for the most part. 15% is a lot less, though this particular community tends to have high real estate value, as most communities in California do, and everywhere seeing some real estate booms. They only generate about 15%. That's how dominant the tourism industry is here, and they still collect about 11% in sales taxes. So that's the picture from the budget perspective. Uh, so why am I spending time on that? Well, I'm an investments guy. I'm just trying to see what the balances are going to do based on what the budget is dictating, and that's why I always like to look at what somebody's at a city or a local government's budget and their CAFR as well, because it gives me a really good picture of what sort of operating environment they're dealing with, um, what kind of financial goals they have, and how that's going to impact what we do for them as an investment advisor on their portfolio. Thereby, what's going to impact your portfolio if you're running this on your own. So it's always good to really look at the big picture, not just show up with an investment strategy out of the blue and not connected to something. So what happened? So they quickly recognized that the coronavirus was going to impact their reserves. Think of their reserves as a bucket of water, and that bucket of water has some level of water in it, the water being money, and that bucket maintains some sort of level of those reserves. And as they use that money to pay for expenditures such as payroll, such as their vendors, and do account payable runs for CIP, for pension payments, for debt service, well, water leaves the bucket. But of course, that water is replenished by revenue sources. So water comes back in, water falls in, and water comes back out. Obviously, if you're using more water than the water coming in, that level in your bucket is going to come down. So some of the things that you have to worry about is how are those reserves going to get impacted, and then how are the investments that you're making with those reserves going to get impacted? That's how you have to think about it. Well, this is a team that was pretty proactive. They quickly recognized that this would negatively impact reserves. The portfolio balances had been maintained at the same level for many years. They had done a similar cash flow analysis to some of the material that we just discussed. They really didn't change the core portfolio size for a long time and really relied on that liquidity cushion that they maintained at the state pool. And that worked well. It was a very good approach. But what they noticed is because of the impact of coronavirus, their liquidity ran low. What they began to do is they started liquidating funds from LAIF. The impact was so large that eventually they started moving to liquidating, actually selling funds before maturity from the core investment portfolio. And they did that in certain increments to meet cash needs. Now, what they did was pretty smart. At least when they were forced into this corner, um, they didn't want to impact that long-term portfolio because the yields, a lot of the yields held in that portfolio had been picked up back when interest rates were higher. So the returns, the interest income in this portfolio was quite competitive. So what they ended up doing is they just identified certain tranches and worked with us to make that money available. If we go to the next page, we can actually just take a look at some questions uh, about what you might do. And this is just simply to get you to think about it, okay? So what steps might have been taken to mitigate the drain on resources? So I mentioned that they had a pretty tight ship, a very well-run program, enough what they considered enough liquidity. But given their profile, their revenue profile, what sort of steps can be taken to mitigate that drain on reserves? And that's a thought question for you. Here's another question for you. Given the fall in interest rates because of COVID, what was their optimal place for their cash, meaning their most liquid component? Where would have been the best place to do that? So that means that you have to think about what yields for securities, individual securities did. You also have to think about all their other options, such as the state pool, LAIF. Another question might be, what might be a good step for them to shore up those reserves into the future? How would they approach that? Could it be the budgetary cash flow analysis sample that I showed you? Could they rely on past patterns to be able to extrapolate statistically what that might look like into the future? That's a question for you to think about. And then, of course, any other final thoughts? Perhaps you went through a similar situation in your local government, in your public agency, and it would be really interesting to hear how your finance team tackled all of this and how they solved that problem. Maybe you're still working on it. Many people are. There's no right answer. It's really just to get you to think about it. Angela, let's go to the next slide. This is a second case study. This is another city. This particular city is actually in the Central Valley, and their main source of revenue comes from charges for services. So think of a bunch of enterprise funds that they maintain, utilities, water, sewer, that sort of thing. So pretty developed in that. They do pick up about a fifth of their revenue from property taxes, and there's some transfer in revenue that comes into about 10%. In this particular city, this is a city where the revenues had been steady for a long time, less so dependent on hotel taxes, less so dependent on sales tax. It's a different story here, different region of California. That team feared that COVID would put a pause on what had been a pretty good run for them over the last 5 years. Because of that run, their portfolio of reserves, which is what we're talking about, had grown considerably. So much so that they hired outside help to manage it and help really put together that bifurcation that we talked about, the two separate approaches, one for liquidity and one for core funds. And those core funds were managed to a benchmark, and the returns have been good. So concerned with liquidity, they really were worried that COVID, there were so many unknowns back in March when everything shut down, that they didn't know what was going to happen with liquidity. So they were very, very concerned. One of the things that they did was they started to rerun all their cash flow projections. And they were afraid that they would have to start dipping into the core portfolio and start selling out of things to be able to make liquidity. Well, eventually what happened to them was that they started realizing that revenues were steady. So what they did is they worked with us to allow a lot of maturities to roll in just in case, even though revenue stayed steady and expenditures were carefully looked at. They worked with us to allow maturities to roll into cash rather than reinvesting those maturities into securities further out in the yield curve, achieving yield. So that cash built up. It did, and that itself became a bit of a conundrum to look at. Obviously, that's a high class problem to have when you have cash and you're trying to find places to park it. It's great that you have cash. Other communities didn't. Let's take a look at the next slide and look at the questions here. And again, these are to provoke thoughts and perhaps a discussion. Perhaps you have questions. Perhaps you want to save it for the small group sessions later in the week, or maybe you just want to email me about it. I don't know. But here's the question to you: were they too conservative? Can you be too conservative? I always hear this answer from public finance officials in California. I'm not going to lose my job, or I'm not going to gain huge accolades for earning 2-3 more basis points, but I might lose my job if I don't have enough liquidity to pay for expenditures. So the question is, were they too conservative? Because they started leaving a lot of money piling up in short-term investments like pools, which were whose yields were starting to come down dramatically, and there was a timing aspect to that. But were they too conservative? Could they have done better by sticking to their strategy? Had you been in their shoes, how would you have addressed this excess cash that started to pile up? That's a question. Would you have made any changes to the portfolio structure? In this case, this particular city targeted a duration target and an associated range of maturities. And the question to you is, would it have been prudent to change in midstream and maybe target a different duration target and change the overall risk profile of the portfolio? Maybe even make it longer, maybe make it shorter. What would have been the impact of that? Is there a right answer there? I think there is, and that's something for you to think about. And then, of course, are there any other recommended actions that you might have in this case? Perhaps, again, you work at a city or a special district where this was a similar situation and you had to scramble to find places to be able to park all this cash. Those are the questions. I leave them to you. You're welcome to ask me or discuss any of these, or perhaps ask about any other questions in the presentation that we just did. My hope is that we've given you some good information to think about, perhaps some applicable tools. And when I say applicable, I mean that maybe the word is applied. You can apply them to your day-to-day jobs and utilize them to be able to do your job more effectively every day. I want to invite Robert to come back and join us. Robert will help us lead up any questions that pop up and kind of take it from there.
Good morning, everyone. Good morning, Carlos. Yeah, we do have a few questions. Just very quickly, some comments on the last case there, the Central Valley case, Carlos. Sue suggested that, I believe what she's saying here in her questions is that, or in her comment really, is that she is concerned about losing her job, as she pointed out, and her suggestion would have been to use LAIF in this situation. That was her comment. And do you have any suggestions or comments relative to that?
Sue, and I don't know your last name, but Sue, wherever you are, that's a great comment. Thank you for bringing that up. And here's why it's great. I'm going to tell you why it's great. The reason is because in this particular hit to our economy as a result of the coronavirus, let's think about what happened. Interest rates fell dramatically. First and foremost, because the Federal Reserve provided stimulus to get the economy going, and their primary recession-fighting tool is the federal funds target rate. And in the course of about 5 weeks, they made 3 different interest rate shifts that basically brought that target rate down to 0. Now, when you look at yields and maturities, the maturities that are most impacted by Fed policy are maturities 2 years and shorter. It means that maturities 2 years and shorter drop down dramatically to where they are. In fact, the 12-year has been wavering between 12 and the 2-year, is wavering between 12 and 14 basis points for the past several months. So 0.14% to earn on that 2-year investment, to give you an idea. 5-year yields weren't much higher than that. Okay, so what did this team do? Well, they had liquidity and it was piling up, and the question to them was, do we maintain this strategy and keep pushing investments out longer, and maintain that duration target. Their particular duration target was 2.5 years, approximately 2.5 years. Or do we keep it ready to meet cash needs in LAIF? They opted to do exactly what you just recommended. And the reason for that is because LAIF, much like their portfolio, has investments that go along the yield curve, and they make up their quarterly apportionment rate from the yields that they collect there. The beauty about LAIF is that it's dollar in, dollar out. They provide you a mark-to-market figure at the end of the year so that you can do your GASB 31 adjustment, but it's really all about book value. You put $1 million in, you're going to get $1 million back plus your interest income, and their yields lagged, meaning it took time for their yields to come down. And I think when we wrote this, I think I quoted 57 basis points. When we recorded this was back the week of Christmas. Yield last week was down to 44 basis points, and they dropped 4 basis points in 1 week alone. I think 1 or 2 weeks alone. So they're coming down very quickly, as their team predicted, because when they make investments, they have to do it in the same markets that you and I have to do it in lower yield. So that's exactly what they did. That's exactly what the city did, is they piled it up in LAIF because they did two things. Number one, it provided liquidity. They needed, in case that they needed it, in case that revenues dried up, and that's what they were afraid of. They needed to have quick access to cash to meet needs that they normally would have met from incoming revenues. So that took care of that. The second reason was because it was providing a very competitive yield to what they could do in the market. Now, here's the thing that was in the back of their head, which is a discussion that we continue to have to this day, which is, when is the right time to start moving back into the portfolio and moving that duration target back to where it used to be? I can tell you that now there are sections of the bond markets that you're allowed to purchase, and maturities that you're allowed to purchase, that are now out yielding LAIF. And the discussion is, we have this long-term strategy, because this long-term strategy, as I discussed in the recording, it gives us a level of expectation of the type of return we're going to get and the type of volatility. If you don't look like your strategy, something different is going to come about. Eventually, if you stay too short, you may not achieve the kind of returns that you would get. No one knows where the markets are going to go. This is why you maintain that strategy and you kind of keep it as a bogey. So the question is, when do you move out of LAIF? Well, in their case, they maxed out at LAIF. They're full. LAIF caps you at 75 million. So they needed to find another use for their cash, or another place to park it. So that pressure to start resuming their investment program to their duration target has been increasing by the day, and that's a dilemma. That's honestly, the way we've tackled it is observing the markets, discussing it, revisiting their revenues, revisiting that cash flow analysis, literally doing exactly what I just showed you, looking at that model, that big spreadsheet that I showed you, and revising it based on what they're observing. They've done really well. And they're a great team to begin with. They're awesome to work with, and they've done really, really well for their city. I would say that my answer, you could have a different answer, but my answer to, were they too conservative? I probably would say no, they weren't. They did exactly the right thing. It's worked out well for them. But I guess the answer to that is, if it works out. If it didn't work out, then you may be able to throw stones at that. That was a very long answer to a very simple question, I think, but I hope that helps.
So I hope Sue comes to the small group session on Friday. I think she's got some more thoughts, but one of her thoughts about where rates are now is consistent with another question from Kelly. Is there more interest rate risk investing in bonds with lower maturities when interest rates are bottomed out? What happens if rates increase and the invested funds are locked in investments with longer maturities? So as you start moving out that yield curve.
So let me answer that second question first, which is, what happens? Is there more interest rate risk? What happens if you're investing in longer maturities and interest rates start to rise? What happens? The answer is yes, there is. What happens is that the longer you go, the higher the duration, the higher your exposure to market risk. Okay, it means that the longer you are and interest rates start to rise, the bigger the negative impact to the fair value of your investments. Think about it like this. If I've bought a 2-year investment and interest rates start to rise, if I'm just holding the maturity, I have to wait 2 years to get my money back to reinvest in higher yields. It means I'm stuck earning that interest income for a long time, for 2 years. If I do that with a 5-year investment, it's even longer. It means that the value of that income stream is going to fall even faster and more than had I stayed shorter. That's the risk. So again, excellent question, and here's why I think it's excellent. If I call it excellent, I'm going to tell you why I think it is. The reason I think it's excellent is because let's look back at the recession in 2008 and 2009. A similar, not similar in terms of its outcome by any means, but a similar situation where the Federal Reserve dropped interest rates down to zero and maintained that for nearly a decade. In that time frame, there was some level of steepness to the yield curve, which I talked about at the end of the recording, meaning there was a modicum of higher interest rates and yields for longer maturities than had you stayed shorter. But a lot of investors sat waiting for those rates to come back up. They thought, I don't want to get too long. I'm piling on that market risk. I run the danger of interest rates rising. I'll just keep it short. And then as interest rates start to rise, I can then move out to those longer maturities. And that sounds like a really good strategy on the face of it. But what happened there? What happened was that if you were one of those investors waiting for rates to rise, you waited nearly a decade. During that time, you could have captured relatively higher yields. You could have also actively managed your portfolio to protect fair value during that period and do better than had you been one of those investors that simply piled it onto the state pool and kept it short, which is what the state pool is designed to do. So why am I telling you this? Because I don't know how long rates are going to be this low. The Federal Reserve is giving us an indication that it's going to be 2023, 2024 before they start rising, before they start bringing up the federal funds target rate. So that means that we're going to see this for a few years, but nobody knows. In order for me to, basically doing that to just pile short or pile long is, for lack of a better term, a lot of people would call that market timing. And the problem with market timing is that none of us have a crystal ball which will work 100% of the time. I don't know when rates are going to rise. I would have to know when they're going to rise. I would have to know in what maturity ranges they're going to rise and by how much, so what magnitude, and for how long. That's a lot of things to have to call exactly right to be able to optimize this portfolio. So what do? Well, what you do is yes, I think that your question, that's an extreme that I gave you, an extreme answer, but I think your question calls for being tactical. If there's an opportunity to earn a decent yield and short, or if there's an opportunity where you can go on a limited basis longer, then you do it. But generally speaking, the way that we tackle this is we maintain a duration target. We maintain that average, and we diversify everything, not just your issuers, not just your sectors, but also your maturities. You want to diversify your maturities. Those investors that did not diversify their maturities before COVID-19 and kept things extremely short, those are the investors that are now reinvesting at 18 basis points, but their entire portfolio, not just components of it. Those investors that diversified their maturity still have components that they bought a year ago, 2 years ago in the 5-year range and picked up the higher yield, and they're still earning those great yields and their returns look a lot better. So the answer here is yes, be tactical as much as possible, but only on a limited basis. When you have a strategy, stick with it, and over the long run, it's that diversification that's going to carry you through.
Carlos, speaking of those the higher yields in LAIF, a question from Molly. If many public agencies are moving large amounts of cash into LAIF, does that drive down the return of the pool faster, since the cash is invested in lower yield investments for the pool?
The short answer is yes, it should. Like any other pool, they maintain an average maturity, similar to the strategies that I've been talking about here, where they maintain, where I've been talking about targeting a longer duration target. Leif effectively does the same thing. They just do it a lot shorter to provide that liquidity, because that's their primary job, is to provide that liquidity. Every time you have new money coming into Leif, that means that the Leif team has to go out and invest that. Now, they have ways to mitigate that by doing the things that we've talked about: diversifying your sectors, diversifying your issuers, diversifying maturities. They can do that. They can mitigate that to a great degree. But yes, and in fact, that was one of the questions. I think, I'm just thinking back to the Leif conference, I think one of the attendees asked, where do you see this going? And I seem to recall one of the Leif team members saying, look, we're looking at things like property tax collections, which happen up to the run up to April 10th and December 10th and April 10th. And that's a lot of money that we're going to have to invest. And when they invest it in lower yielding securities, because that's all that's available. And when you look at that, that's going to drive the average yield down. So I mean, I'm just relating, and you can probably go and look at their website, and I think there even might be a recording of it. Very informative. And but precisely that happens. The question is, how long for that to happen? Well, that team's done a pretty good job of keeping a very competitive yield for this long, considering that we've been in this mess since March. They just dropped below 50 basis points right at the end of the year, 2020. Gosh, that's pretty good.
Question from Robert, not this Robert, another Robert. He says repos were a great tool to manage daily cash needs until banks dropped their repo rates to zero. Curious to know what other agencies with active cash flows are doing to manage their daily cash needs.
Well, from what I've observed, I don't work at a public agency, so I can't tell you what mine does since I don't have one, but I can tell you what my clients are doing. And what I've observed is that repo, especially if you're looking at overnight repo, that tends to be very tied to the money markets, and it tends to be tied, often overnight repo is going to be similar to a 30-day commercial paper rate. Well, the money markets are heavily influenced by the federal funds, by Fed policy and what the Fed funds target rate is. Right now, as the question, as Robert stated, that's no longer as big a play right now. What I have observed people doing is they have been going into Leif as much as possible, and that's been a very strong game in town. There are other options. There are some local government investment pools, some in the form of a JPA, which have longer duration targets. They do precisely what I've been talking about here, managing to a duration target for the most part. But at the end of the day, they're still designed for liquidity, and you're doing it in a pooled setting. Here's what that means. It means that they have kind of one strategy for all their participants, and then you just sort of, you get what you get. But here's the thing. Unless you're Leif, or unless you're a pool that manages similarly to a 2a7 money market mutual fund, generally speaking, the share value of your shares, the net asset value of your shares, fluctuates. Is that a bad thing? No, of course not. But you have to be aware of that if you're using it as a liquidity vehicle. You have to be aware that you may put $1 million in, and putting yield aside, the value of those shares may go up or may go down, and that fair value adjustment gets passed on to you. In a portfolio of securities, you can always hold your securities to maturity. So you just have to be aware of that. It's not a bad place to be. You just have to understand that dynamic when you are managing your liquidity program. But I've seen that. I've seen if you've got deals with local banks that are hungry for your deposits, that's disappearing. They oftentimes will promise you Leif plus a spread. I haven't seen one of those right now because they can't afford to do it. But that's another option. But for the most part, the easiest and kind of the biggest game in town has been to go to Leif, is what I've observed.
Okay. A question here relative to using Leif as a benchmark. You use it as a benchmark of sorts in your presentation. Does it make sense to use Leif as a benchmark for a portfolio given its duration? Are there specific kind of agency profiles that revenue expenditure profiles that might use Leif as a benchmark?
Excellent question. Excellent question. Here's why. Leif has a weighted average maturity of somewhere around 6, sometimes up to 9 months, I think is as high as they go. The real purpose is for liquidity. And perhaps you have a portfolio that's averaging 2 years or 2.5 years. And the question is that really an appropriate benchmark to be able to show what you did? Well, based on everything that we've discussed today, right now in this live session and also in the recording, we talked about longer duration targets having more volatility, but more return potential over long-term periods. So than a shorter duration or a shorter average maturity approach like a LAIF. So the question is that an appropriate benchmark? I would probably argue no, it isn't, because your risk profiles are very different and they have two very different purposes. There are a number of benchmarks that are out there, but the benchmarks are designed. So the benchmarks that I'm thinking of are the industry benchmarks that are widely used in short duration. They used to be known as the Merrill Lynch indices. Then they were the B of A, the Bank of America Merrill Lynch indices, and now they're the ICE BAML. ICE is Intercities Exchange, Bank of America Merrill Lynch indices. It's a long name, and that's a commonly used. There are others. Those aren't the only ones, but they're designed to provide you a total return comparison. So rather than a yield to maturity on a given standpoint, like say for example the daily yield, LAIF yield, they're designed to do a look back for a given period and tell you how much economic interest, how much gain, how much growth you were able to witness in your portfolio or in the index for that matter, for that given period. And that growth comes from in all the interest income collected for that period. If you sold something before maturity, any realized gains and losses, but because it's a total return, it also looks at the mark to market. So all the unrealized gains and losses, the gains and losses on paper. From a budgetary standpoint, you may not care very much about those, but those are real, they exist, and those flow through to your CAFR. GASB 31 has you mark to market your investments. And even though many treat that as an accounting adjustment, it's a true economic event that has to be measured. So those total return benchmarks provide that. So it's very holistic, very, very holistic. But that's one way to tackle that question, is to look at an industry benchmark with an index that has a similar duration target to your portfolio. That means that you're putting together a bogey, for lack of a better term, I'm using that sports term, but you're using a bogey with a similar risk profile than what you're trying to achieve. And that's a good way to do it. Now, having said that, I'm going to reverse myself. Let's look at who looks at these benchmarks. Who really looks at these benchmarks? Well, your first and primary audience is usually your governing board. If you're in a city, it's a city council, and most city council members are very familiar with LAIF. And the way they might approach it is to say, well, what's our other alternative? I mean, what's the state doing? And if they say that, then you may want to be looking at LAIF at least as a reference point for them.
Okay. Here's an economics question for you. You ready?
Okay.
How good of a predictor is the inverted yield curve of an upcoming recession?
You know, I saw a JP Morgan chart that tried to tackle just that last year. I'll have to dig it up. If you send me an email, if I can find it, I'm happy to distribute it. But I saw JP Morgan study on this. What they did is they tried to define the inversion, and it was between 3 months and 10 years. And when they looked at that study, I think that since like 1988, it predicted it something like 8 out of 10 times. There's a very strong correlation with it. It doesn't mean that it's causative. It just means that if this is happening, it might be because of this, and it might be a very strong might be. Yes. What happens in an inverted yield curve? Well, what happens is that investors perceive the end of a business cycle and perceive that aggregate demand is slowing down, and perceive that at some point inflationary pressures are going to decrease. Okay, that's what they're thinking. All right, because you have a slowdown in the economy, price pressures slow down. Okay, so what does it mean? It means that eventually, that slowdown might harbor future lower central bank rates. It means that the Fed might be lowering rates to make it cheaper for people to borrow, to bring that balance between employment and inflation in line. That's their job. They're trying to promote full employment, but that promotes inflation. So they have to tamp down inflation because too much inflation can derail your economy. And that's what they're trying to do. So that means that lower rates means cheaper borrowing. It means increased velocity of money. All of that is stimulative. Okay, so what do? If they think that rates are going to come down and lower inflationary pressures, remember what I talked about the yield curve? Rates 2 years and shorter are more impacted by Fed policy. Rates 2 years or longer than 2 years are generally impacted by inflationary expectation. So if there's lower inflation, what they're going to do is they're going to anticipate lower rates. So what do? You buy up securities with longer maturities, and that has a dual impact. Number one, if rates begin to fall, the value of that investment goes up, and now you've just added to your total return. The second impact, of course, is that if rates go down, if you are shorter in your average duration, you are forced to reinvest faster than someone who has a longer average duration with those longer maturities. And in this market, you're forced to reinvest faster at lower yields, lowering your income stream, impacting your budget. So all of that to say is back to the question, which was, are they a strong predictor? It's not causative. They don't cause them, but they're a very strong indicator. Statistically, they're a strong indicator. And if you just Google, there's a bunch of charts and studies on this. It's been out there.
Well, we're approaching the bottom of the hour here, our wrap up. I wonder if you, this was a presentation about cash flow and cash flow projections. What advice do you have for our audience here as a wrap up of your presentation, the most important points, particularly in light of what people are struggling with the COVID crisis impacting their revenues and modifying their expenditure projections as well?
Robert, that's a really good summary, or I should say, kind of note to end on. I would leave it with these. I would recommend these things to think about it. Always think holistically. Look at the overall investment program, every component of it. Code identifies all your cash as an investment. There's different terms for it. Your cash can sit in deposits, and those deposits are active or inactive. I think it's in 53630 government code where all of that is defined. But basically, it's all an investment. You're going to earn something on it. So look holistically, because it's all available to be able to meet your needs. The reason we put these case studies together was because the case studies gave you some real life situations, and less so about building that model. That model, there's a sample of that in this presentation, and you'll be able to download it and you can copy it. But at the end of the day, is what do you do with that data that impacts it? And you have to think holistically. What's impacting this? The revenues, the expenditures, the timing of the expenditures, the growth of the expenditures, the anticipated growth of the revenues. If there's a strategic business plan, a strategic plan that the city or county or whoever you are is approaching, all those things are going to impact this. So you really have to think holistically. The other thing that I would tell you is that don't be afraid of the shift in interest rate scenarios. What I mean with that is, some people say, oh no, rates are rising. It means that you're going to lose value in your investments, okay? Yeah, but you're going to get higher income streams that are going to impact your budget directly. Or, oh no, rates are falling. It means that I'm going to lose that income stream. It's going to be lower. Well, yeah, but the value of your investments is going up, and that potential value can be used in the context of an actively managed portfolio. So I don't be afraid of that. Just adjust, but I would make my adjustments to be incremental. I wouldn't make wholesale changes in the portfolio. Averaging an average duration that resembles your risk parameters, that's been a very tried and true tool that bond managers have used for decades and decades. It works. The last thing I would tell you is talk to your neighbors, talk to your peers. There's a lot of really good, smart people in public finance that have been doing it for decades. They've got a lot of experience and they've seen every manner of environment. And COVID is a different environment. None of us have lived through a pandemic, but they've seen a lot of instances where they can take that as part of their playbook to figure it out, share information with one another, because there's a lot of smart people, a lot of smart finance directors out there who are doing exactly what they need to be doing. And those case studies, I don't mean necessarily these that we post here, but case studies where you can see what other people are doing, that's how you learn.
Great. Thank you, Carlos. I think that's going to wrap up our presentation for today. I just want to remind everyone on the session, especially Sue and Sarah, there was some comments as you were making your points about their questions. I'm sure that they would like to talk to you more about the case studies, and so I would invite them to definitely come to the small group sessions on Friday. They're at 10 and 1 p.m. And if you should have received a registration link to those sessions. If you haven't, then you're not registered. So go ahead and contact the CDIAC education unit. Give us a call. We'll get you registered, and so you can participate in those small group sessions and follow up with some more questions about the case studies and other questions for Carlos. I also want to remind everyone of our final session on Thursday. This is the session on investment accounting, disclosure, and reporting. Angel Hernandez, Karen Jones, Jenny Lees, and Dan Matuszewicz will be on that session. It'll be at 10 a.m., 10 to 11:30 on Thursday. So that'll be our final core session. And then, of course, the small group sessions on Friday will follow up on that as well. So all of our panelists will be available. The panelists that appeared during the week will be available on Friday to talk to you in more detail and answer more specific questions. So with that, I'd just like to thank Carlos. Great presentation. Really appreciate it. Thank you all for joining us today, and I hope to see you on Thursday and in our small group session on Friday. So long.